Investors Chronicle.
Welcome to the Companies and Markets Show, the podcast that gives you expert analysis on all the latest market and listed company news. I'm your host, Dan Jones, and this is what you need to know. Hello, everyone. It's our first show of the year. It's Q1 2025, the start of the second quarter of the 21st century. And as the seasonal slumber starts to fade, we're looking at how retailers have fared over the crucial Christmas period. We'll start today with Next, often described as a bellwether, but in reality perhaps ploughing its own furrow. Mike Fahy is back with us to discuss its trading update. We'll also touch on updates released today by one of the big successes of recent years, that's Marks & Spencer, and Mark Robinson will look at the news from Greggs. We're not only focused on the high street, though. Mark is also going to talk us through his cover feature this week, looking at the golden rules of risk management, asking, among other things, how investors can diversify, and a very timely discussion this, given how bond prices have been falling in recent days, whether bonds can still act as a diversifying asset. Alex Newman is here as well to give his thoughts on much of the above. We're going to begin, though, with Next. A trading update out on Tuesday. It's pretty much always the first out the blocks, Mike. What did it say about the Christmas period?
The Christmas period was very strong for Next. They said full price sales were up 6% for the 9 weeks to the 28th of December. That was slightly flattered by the timing of sales, of its sales and its markdowns, but only slightly. I mean, once you adjust, sales were up 5.7% for full price, and that was well ahead of its guidance, which was 3.5%, and also well ahead of the wider high street. They said that equated to an extra 27 million of full price sales, which then edged up profit guidance as well.
Yeah, all seems fairly good from the rearview mirror perspective. The guidance for the year ahead is somewhat muted, though. We've come to expect this with Next. Do we think in this case it's a case of setting itself a low bar, given it's beaten expectations for X many quarters in a row? It's raised guidance so many times over the past couple of years. Or do we think its usual conservatism is perhaps particularly warranted right now? Because as we'll come on to, there are a lot of pressures on retail at the moment and other retailers too.
Yeah, I think looking at it from right now, it's kind of difficult to judge, but I do think there is cause for more conservatism. I mean, when you look at, there are a slew of trading updates out today, and from companies that have done quite well. We can get to some of those later as well, like M&S and Tesco. And although all of the trading updates for the Christmas period were all quite upbeat, when you look at the limited outlooks that they give, they're all much more negative, and the share prices have responded accordingly today. Quite a lot of them are down, and some fairly heavily.
Well, one reason for the caution is the impact of higher wage costs, higher national insurance contributions from the companies. You mentioned quite brief outlooks, but Next is a bit of an outlier on this front in that it does like to give quite granular details on how it's factoring in these things. So what did it say about wage NI costs and how it's going to factor them in and maybe offset them?
So for Next, they said that the effect of both the increase in the national living wage and the increase in national insurance contributions, their costs, wage-related costs, are going up by 67 million next year. In total, they're looking, that's going to be the bulk of the total cost increases of about 81 million, which includes a bit of higher marketing and tech spend. But they have argued that they will be able to mitigate most of this, a lot through operational efficiencies, but they also intend to increase prices by 1%, they said, which they described as unwelcome, but lower than the general levels of inflation which are expected, which the BRC the other day had said they expected inflation to be nearer 2%.
Yeah, that wider picture, you've written about that this week as well. We've got a bit more detail today with the various trading updates on the company-specific level, but what kind of figures have we seen over the Christmas period across the sector?
Across the sector, taking the British Retail Consortium's figures, they'd said that sales over the Christmas period were up 0.7%, which, when you consider the optimism coming into the period where PwC were forecasting increasing spends of 5%. Okay, maybe not all of that was going to be on goods, and more of it would be on experiences. But when you look at it, it feeds into that sort of more downbeat expectations. The 0.7% headline figure in itself isn't great. Food and the supermarkets have done very well. Food growth was up 3.3% sector wide, but that obviously means there's been a fall elsewhere, and non-food was down 1.5% for the year. Footfall was down. The number of store visits right across was down for the second year in a row, although retail parks did quite well. Elsewhere, shopping centre visits down, high street down. So it feeds into that slightly gloomier picture.
We'll come to food in a moment. Just on next, though, maybe some final thoughts. It was a trading update, so we don't change our recommendation, but how do we feel about the valuation given all these moving parts?
I think there is possibly a little cause for concern. I mean, you look at analyst views on it, and they make the point that this is what Next does. I mean, you mentioned the bellwether. I spoke to a retail analyst who said it's completely wrong to describe them as a bellwether because, as we've just said, they not only regularly beat whatever else is on the high street, but they regularly beat their own guidance. This was their eighth upgrade in a row. And quite a few of the analysts seemed quite sanguine as well, pointing out that this is, Next is always conservative in its outlook, and that they expect further upgrades as the year goes on. Now, whether that happens or not is obviously going to depend on the wider economic picture. But before the trading statement came out, I think there was a Deutsche note talking about the fact that there probably is a need for more caution given the slightly softer trading environment, and that it is the fact that it's continually exceeded expectations means that beating them in future could be harder. Now, the flip side to that is it's valued at a premium. It's valued at the top end of where retailers are at about 14 times earnings. And although it's, profit growth for next year, it grew profits by 10% this year. But when you feed buybacks and dividends in, it's looking at a total return of about 14%, I think, for shareholders. Profit growth for next year is only forecast to be about 3.6%, which is in line with sales. But again, it's going to continue doing buybacks, and it'll continue paying a decent dividend. And so you're looking at a total return for next year, according to Next's own guidance at the minute, of about 9%, which in a tough market may be somewhere where you want to be.
Mm. Well, let's turn to the food side of things, at least in part,
Mm,
in the shape of M&S,
yeah.
because food inflation, as you mentioned in a piece you wrote this week, there was a bit of a price war for Christmas dinner breaking
Yeah.
out in the final weeks of December, and yet we're now in this period where we are again looking at some food inflation ticking up a little bit. M&S's update today, clearly their shares have had an incredibly good run. Seems to me like it was a fairly decent update, but again, the guidance, the outlook has got people a little bit concerned in terms of how they deal with inflation.
I think when you look at Christmas, the results came in really strong. Total sales were up 6%, and that was driven pretty much entirely by food. Food sales were up nearly 9%, which is a really strong performance. That is based partly on pricing, but it's mainly on volume growth. They were talking about volume growth of 6.6%, and they've said that the new stores and refurb stores that they have, or the stores that they've refurbed, have all performed really well. They've invested in their own supply chain through Gist, and that's had an impact on the availability of food. So when you look at it, it's really quite bullish. But then, as I said earlier, the shares derated today. Part of that may be due to the fact that, as you said, they've had a good run, but part of it is down to, again, a slightly more downbeat guidance. They were also talking about inflation and interest rate environment being uncertain, and that the business is facing higher costs from the higher taxes. They are also quite well priced. I think they're about 13 times earnings, but that food offer, they've done really well in that market. And I was looking at the Kantar data for food overall, although Kantar doesn't really, although Ka although Kantar doesn't feature M&S, it does show because they consider them not to be primarily a grocer, it does show, that there have been big winners and losers, and the likes of Asda and Morrisons. Asda's market share fell substantially over Christmas. It was down a full percentage point. Tesco's been a gainer, Sainsbury's has been a gainer, and M&S has really been a big gainer from food.
Indeed. We're going to carry on, even though at least a couple of us keep turning away from the microphone to cough. That's the perils of doing a show in January, I suppose. Let's turn to Greggs, which might have more serious problems. Its trading update today, Mark, like-for-like sales growth decelerated for the ninth quarter in a row. It was a bit below consensus as well. What did you make of the figures?
Yeah, I guess I should apologise in advance as well in case I do end up sounding like Joe Cocker. Like Next, it would seem that Greggs for a long while seemed to defy gravity. All of us remember how well they performed during the lockdown period when there was a major threat to the company then. This time around, the problems facing the company are a little bit different. They're not really of its own making. As you mentioned, there was a significant slowdown in like-for-like sales growth between the first and second half. It's come in under a broker forecast as well. The difficulty, of course, is that they point to falling footfall on the high street. That's an issue because while I think that Greggs products themselves demand is fairly inelastic because of the price points and the fact that it is a value proposition. The fact is, a lot of people go into their stores when they're going somewhere else on the high street. So if we've got reduced footfall there, that will invariably feed through into volumes for the company itself. Now, whether this persists through 2025 is difficult to say. Management went with their guidance for full year 2024, but there was little in the way forecast going forward apart from that downbeat assessment of consumer sentiment. The company as well spent, they had a record year in terms of store openings, and plus they're building capacity, extended the product range to draw in more summer revenues as well. All of these things are obviously positive, but if the punter isn't around, then it's a major problem for the company.
Yeah, it's a good point. You can now get 12 weeks of an Investor's Chronicle print and digital subscription for just £12. You'll get instant access to our website and our app, plus the magazine delivered to your door every week. Check the terms and conditions in the show notes for more information. Greggs also has a particular exposure to these higher costs introduced in the budget that will be coming in April, the wage costs, NI costs as well. What did it say about these?
They obviously pointed to increased labour costs as a result of the national insurance increase as well. But the other side of that was that they were expecting an increase in disposable income through the economy itself, and they looked at that as a positive for demand for their products, although I can't see that myself because it is, again, Greggs is all about a value proposition. So I think they might have been clutching at straws a little bit. At any rate, that increase in disposable income in the economy mightn't be as pronounced as originally thought because of what's happening with interest rates at the moment, or what's likely to happen with them over the next year or so.
Well, we'll come on to that, no doubt. Yeah. I was just going to bring in Alex at this point. Alex, what are your thoughts on Greggs' current situation, not just the trading update, but the general sort of state of the business, perhaps?
I mean, the shares are clearly having a bit of a reset at the moment, and they're down sort of 10, 11% today. And that's to be expected. I mean, I think just to return almost to our conversation about Next, is that the problem in some ways facing Greggs is that it is, because of its success, it has been handed a growth rating. So, Next I think part of their consistent caution is at least is at least to kind of resist the market's inevitable temptation to treat them as a growth stock. Which, if you look at them long term, then they you can call it quality, or you can call it growth, but they've managed to grow really well for decades, and that's the same with Greggs. Though the growth has been a lot racier over the past decade, they've just managed to. I mean, they obviously hit the sweet spot in terms of product and value proposition for the UK consumer, but it's an excellently run business, and they're very good at recycling capital back into the business and growing it in the right way. I think if they were going to come back on the high street point, they have obviously flexed their estate and put themselves in at points, either be it in sort of transport locations or drive-throughs, etc., where they have insulated themselves slightly from the long-term decline in high street footfall. Other than that, I wouldn't disagree hugely with what Mark was saying. Only maybe just to throw in a couple of sort of slightly longer term points, cognizant of the fact that Greggs has managed to bounce back and almost defy the points at which we are either, there's a lot of talk about reaching peak Greggs, or it's looking a bit gloomier because they are in some ways a retail play. There is one cause for concern. Well, it's kind of a joint cause for concern. I can't see them expanding abroad. I think there was a story last year where they've got a couple of people in the business working on a sort of exploring how they would launch overseas, but I can't see that happening. And the question then is what happens when they hit 3,000 stores, which is going to happen in about 3 years at the current growth rate. Is that where Greggs is completely saturated the UK? Possibly, and the story will then need to move on. But the two cards I think they can play is one on franchising, which they've either got quite a lot of room to do, and if they execute it to the standards that McDonald's has, then that is likely to be a great news for shareholders, potentially over many years, because it really improves the returns on capital, and if well managed, it can sort of reduce earnings per share. And the second one is, I think that at some point their management team is going to have to think a bit more left field, and I think they've really proven themselves that they can run a business very, very, very well. And I think that one of the long-term challenges for Greggs is to decide whether they can turn their attention to something new. It's never easy, and it's a big ask, and there might be a greater temptation to sell themselves to a third party. But I think they've proven themselves very capable managers of the tough UK retail environment. And whether there is an opportunity out there, over the next 5 years, once they do reach peak Greggs, to sort of repeat the formula, I think that will be the chapter that eventually they and investors will have to consider.
Yeah, it's definitely coming to a point, as you say, where some of these decisions need to be taken. The franchising is an interesting aspect, isn't it? I think about a fifth of their stores currently are franchised, so there's certainly scope for a lot more there. Let's move on from retailers now, though, and look at the wider picture, which is perhaps similarly fraught. There's a lot going on at the start of the year already in markets, as you might expect. We're going to look at this firstly, though, through the prism of our cover feature this week, which is about, appropriately enough, risk management. Mark, you've written that, looking at some golden rules for risk management. Can we start with the thinking behind the piece, other than perhaps the world is a risky place, as it always is?
Yeah, well, really, it's a reinforcement piece, because our readership will be well aware of some of the themes that I cover on it, but it does pay to remind ourselves sometimes about these underlying principles to make a success of your investment portfolio. So that was and we've covered these themes ad infinitum in other parts of the magazine down through the years. But I was just really looking to reiterate these points, possibly because it's the beginning of the year. Even with seasoned investors, there's always the danger of drift, really, that you can fall into bad habits because of some of the issues covered behind behavioral finance, for instance. So yeah, that was the thinking behind it.
This is the time of year when people conversely do like to give their portfolios a spring clean, or wonder if they should be doing that. We certainly get a fair amount of submissions to our portfolio clinic around this time of year, so it's an opportune time in that regard as well to make sure you're still hitting all the basics and the things which maybe aren't quite so basic as well. Can we get into the detail a little bit more then and talk about a couple of the principles that people should be following? We won't go into granular detail of everything in the piece, of course, but can we pick out a couple of bits for starters?
Sure. I did mention first principles in the article as well, and this is something that always puts me in mind of Phil Oakley's approach to investing. The very first question that you should really be asking yourself is, what are your investment goals, and have you got a long-term plan to achieve them? There are many reasons why people might get into the market. There's obviously long-term wealth accumulation in terms of your pension, but it could be for specific aims as well, such as putting your kids through university, saving for a house. So all of these things would would impact the time frame that you employ as well. But it's probably surprising how many people don't ask this most basic question too. I remember talking to our editor Rosie Carr about this, and had she has regular contact with our readership and some of our younger readers too, who seem to have, or some of them have a slightly distorted view of the market, where it's a place that you can go in and make very quick returns and get out again. And of course, as we all know, that you know, it's you're going to be more successful if you take a long-term view and rely on the magic of compounding.
Mm.
There's so many variables on a personal basis, but ultimately, identifying clear objectives will help you balance the differing types of investments within your portfolio, and assess the risk factors involved. Optimize returns without necessarily changing the risk profile of your portfolio.
Yeah, and all that feeds in and interacts with risk tolerance as well, doesn't it? Because it's all very
Yeah.
well having a target, but you need to be comfortable with what you're doing to get to that target. Let's talk about diversification. Some parts of the piece discuss the wider range of options there are for investors nowadays compared with, well, certainly compared with a few decades ago, maybe even a few years ago. Can we talk a bit about some of those options for the private investor?
Yeah, well, I think the standard debate on this used to be just the balance between equities and bonds within your portfolio as well, risk assets as opposed to a guaranteed rate of return. It's moved beyond that now because, as you say, we've have a much larger spread of securities open to individual investors. I think from about 2005 in this country, and probably from about midway through the 1990s in America, we've seen the spread of derivatives in the form of ETCs. These, amongst other things, have provided a good deal more flexibility if you want to safeguard your portfolio against all sorts of measures such as currency movements, commodity pricing, anything that's likely to have an impact. Now, again, you have to ask yourself, if you're pursuing a long-term goals, and perhaps if you're a value investor, there's chances are that you're not going to dip in and out of your portfolio regularly to make these adjustments in terms of risk management. But they are certainly available now, and there's a great deal more open to retail investors as a result.
Yeah, sometimes it can be a case of being careful as well with these options. When you have all these choices available to you, you need to make sure you know what you're buying and things like that, don't you? Let's talk about bonds. Go back to the older split between equities and bonds, because that's where there is a lot of activity, shall we say, and there has been in recent days. Bonds, in short, have been selling off. Bond yields been rising once again. We can talk about correlations a bit here as well, because another thing to consider, of course, when diversifying is how the assets you hold interact with each other, whether they tend to go up in unison, tend to go down in unison, or vice versa. Historically, bonds have been a good asset to hold with equities because they would do well when equities do badly and do badly when equities do well. There have been some indications, though, in recent years that relationship may no longer hold, which people may be conscious of at the moment, given the way bonds are selling off.
Yeah, I mean, that positive correlation was in evidence until about 20 years ago, and since then that's turned negative. But it's worth remembering during that period as well, we had quantitative easing and a vast rise in asset prices as a result of this. You also had probably one of the longest bull markets in history, again down to the fact that asset prices were artificially increased, I guess you could say. So yeah, now we're in a situation, unfortunately, where the outlook on equities, UK equities, are fairly poor at the moment, and yet we've got the sell-off with bonds, something that happened back in 2022. What happened at the moment? I think part of the reason for that is that the forward projections on the Bank of England rate cuts has been reduced. So at one point, I think we were looking at maybe a handful of rate cuts through 2025. That the expectations are now down to just a couple of quarter point reductions as well. So that hasn't played particularly well with the market. And plus, the market's also looking at the Reeves budget and its deflationary effects there too. So, we're almost, I hate to say it, but I think we're almost creeping into recessionary mode here. There aren't many positive signs in that regard. And that's why I think you're seeing weakness in both of those prime asset classes.
Yeah, you're seeing a lot of weakness in bonds across the board, aren't you? Government bonds. Some of it is concerned about what the new administration in the US, whether inflation is going to come back as a result of those policies, whether inflation is going to come back in general in the UK. We've discussed food inflation earlier, and how that's going to interact with a low growth environment. The word stagflation is being thrown around a little. It's never good when it gets thrown around, but a little too much for everyone's liking at the moment. Conversely, I suppose if the economic outlook does deteriorate, we could have a situation where more rate cuts ultimately emerge than people think this year. But then again, we've been in that situation before of thinking more might emerge and they won't. In the meantime, the government is facing a difficult issue potentially in terms of meeting their fiscal rules, because the way that bond yields have been rising, the way that interest rate payments, therefore on debt, have been rising, make it very difficult to thread that needle. So it's a slightly fraught moment, but equally, perhaps we shouldn't forget that it can be easy to get caught up in these short-term moves.
Certainly, inflation has proved much stickier than people originally anticipated, and I think problems there could have. It wouldn't be the first time that the inflationary dragon has sort of been resurrected, but we've had some fairly hefty public sector pay rises as well since the election. I think most of the private sector wage increases had run their course, and then you've got this second tranche, if you like, which will bolster inflationary pressure. So it's very erratic, and the whole economy itself seems out of balance. I mean, the obvious difference over in the US I saw an interview with Gillian Tett the other week, who was talking about the animal spirits that are in the US economy that have followed on from the election. Unfortunately, we're sadly lacking in that in the UK at the moment.
Indeed. Well, even in the US, it's become a little more equivocal, I think, in recent weeks, as everyone waits to see what will actually happen, as indeed we all do. Alex, let me bring you in here. What's your thoughts on bonds, recent movements, or maybe the context of those? I know before we came on air, we were talking about fraught episodes of the recent past, such as 2022, for example. What are your thoughts?
Well, yeah, I mean, it's a big question. I suppose what in the commentary that seems to be emerging already, and it is kind of early days. I know it's been quite a rough week for gilts, particularly have been seized on, but government bonds have been selling off all around the world. I think the obvious parallels people are drawing are with 2022, when the mini budget kind of exacerbated what was already in the water, which was a nearly year-long sell-off in bonds and a real sort of risk-off mode. But I think it would far too early in the year to be talking in those terms. One point I would just maybe bring in relation to equities. I mean, we've talked about UK focusing companies in this episode, and yes, I think the outlook for UK consumer and UK only businesses has to take into account the troubles that the UK economy is facing, and the headroom or lack thereof that the government has in in their sort of fiscal response. Obviously, the budget did hit a lot of the retailers quite hard. But when we talk about UK shares, I mean, the FTSE 100, to take the best known example, is more an expression of the global economy. And there are a couple of things investors can remind themselves, which do soften some of these slightly scary flashes of red that we do occasionally see in markets like this week. And that is, one, and I don't want to add too much complexity to the discussion of assets, but a falling pound, which has been the response to this stagflation concern, is not too bad a thing for FTSE 100 businesses on average, which tend to be international earners, be it in euros or predominantly dollars. So that is almost, there are these kind of inbuilt hedges to when we talk about UK shares that, can act in our favour. And the other lesson, I suppose, from 2022 is, if we're staring down the barrel of another year like that, is that, longer term, if we are kind of coming to grips with interest rates actually staying a bit higher than we were expecting a week ago or a month ago or a year ago, is that equities do learn to live with high interest rates if that is a product of higher inflation, because eventually companies do find ways to sort of improve their earnings through inflationary pressures and pass things on to the consumer. Of course, that's assuming that there is some economic growth, which we can't be sure of in the UK, unfortunately. But again, the UK economy did kind of, I suppose, over the last couple of years, did probably overperform relative to what it was looking like at the end of 2022. So maybe I'm just trying to act as a sort of counter to a gloomy Mark Robinson in the studio. But yeah, I think it all is not lost.
Yeah, I made that similar point actually when I wrote the end of year review. The fact that a falling sterling isn't necessarily a negative point for the UK, given the proportion of revenues that the FTSE 100 companies generate abroad.
It's also been very helpful in recent years for, while we're on silver linings, for people with holdings in funds and assets, such as global funds, for example, because you get another artificial boost from that. Albeit, it'd probably be a better state of affairs if the pound wasn't falling. But again, that is in the context more or less of a strong dollar rather than specifically weak pound, we should say. I think you're right, Alex. It is very early on in the year, and we will see how these things play out. But certainly something to be cognizant of for now. Why don't we wrap up, Mark, just with a brief bit on the company-specific side of risk management? Because, of course, when you're looking at individual companies, there are all kinds of things you need to be aware of, keep tabs on. We can't go through them all now in our limited window we have left, but just some of the kind of the hard data and the soft data, perhaps, that people should be aware of.
Yeah, I mentioned Peter Lynch in the article a couple of times as well. He managed money for Fidelity very successfully for a number of years, and he makes the point that even if you look at all these risk management factors, it comes back to the fundamentals of individual companies rather than sectors themselves. So he counsels that whatever investment style that you might have, growth, value, you need to come back to fundamentals, and I think we all reiterate that point as well. The point that I made, I think, as a starting point for any investors, when you're looking at individual companies, the one thing I would look at would be liquidity and cash ratios as well, because if you're looking for red flags, I guess you should always play devil's advocate to a certain degree if you're considering buying into a company, and one of the most overlooked areas when you've got companies that are failing is that people fail to look at how they generate their money, whether revenues are matching up with cash flows, and how able they are to meet their short-term obligations. So there's ratios like the quick ratio, for instance, that give you some indication of this. And I would say above anything else, when you're looking at the fundamentals, look at liquidity, because companies live and die by their cash flow.
Indeed. That is probably a good place as any to end, because we have run out of time. But as I say, that is the cover feature this week. Do have a look in print online. And thank you very much to all our contributors this week. Thank you to Mark, to Alex, to Mike. Thank you to our producer, Maddie Apthorpe. We'll be back